Hello, everyone. You'll notice the background's a little different today. I'm actually out at my in-laws for the week, so great part about online classes, I can still teach from here. So today we're going to talk about foreign stock, funds, and bonds. So to get started, one of the first things and why we purchase foreign stock um, in conjunction with an asset allocation is because foreign stock usually doesn't go up and down and is not correlated to that of the U.S. stock markets. Sometimes they do go up and down together, especially if it's a global issue that's happening in the world. But for the most part, we invest only a small part, 10 to 15% of our money into foreign companies. Now, the way we do this and the way most financial managers do this is not by investing directly in those foreign markets on the foreign exchanges, but instead use other types of mutual funds that are invested in those different markets, and those are managed and sold through U.S. markets and through U.S. agencies. Now, the reason that is because it's often fairly risky to invest in foreign markets directly. And some of the reasons why it's risky to invest in those markets is usually the information about the investments is not available the way it is here in the United States. The Securities and Exchange Commission regulates and sort of mandates that certain amounts of information must be available in publicly traded investments to the investor. So very important that that information gets in there. And a lot of those regulations aren't standardized throughout the world. They're just here in the United States. So again, there's a lot of information about the investments that's not often available. Regulations are often very different in those other countries. And often there's different restrictions and tax consequences when you invest in foreign markets directly. Most domestic investors, retail investors, instead of using that, will use what's called an exchange traded fund or ETF to invest in a foreign market. If you Google foreign market ETF list, if you want to go ahead and do that now, it'll come up with a bunch of different ticker symbols for all these different funds that are invested in foreign markets. So if you think Japan's market's going to really take off here for whatever reason, then you could find a foreign market or a ticker symbol or fund to invest in that market. Now, an exchange traded fund is very similar to a mutual fund, and a mutual fund is just many different stocks that are invested under one arch. And we'll talk about that a little later on. ETFs are the same, but there's one huge difference between a mutual fund and an ETF. Is the ETF, one is usually indexed, and the quoted stock price changes relative to the stocks in that. So in other words, if I go on to Yahoo Finance and I look up a standard mutual fund, the stock price that you're seeing or the quoted price only changes one time a day, and it's usually at night because you have to do a valuation of all the underlying stocks to figure out the actual price of that stock. So there's a real downside to that, and I'd like to use a little bit of a story about mutual funds to give you an example. Is mutual funds have a higher level of liquidity risk. In 2007, I had invested into a foreign mutual fund through our markets on the New York Stock Exchange, and I had invested in, a couple of $1,000s worth of shares. Well, when the financial turmoil was sort of rippling down from the Great Recession, I tried to go out and sell this mutual fund. And if I had sold it when I put a sell order in for it, it would have only changed in value by maybe 5% from what I purchased it at. It would have decreased in value. But unfortunately, it took a week and a half for someone to finally buy the shares of that mutual fund. And that's sort of one of the downsides to mutual funds is their values don't change. So traders and retail investors often don't like buying and selling those when they're buying and selling in great frequency. Mutual funds, for the most part, especially low fee mutual funds, are still an option for retirement, but there is that downside where they're not very liquid, and liquidity just means the ease of converting those shares into cash. So a little bit of an issue there. Now, a mutual fund, we'll get into what that actually is a type of professionally managed collective investment vehicle that pools money from many investors to purchase a pool of securities. Technically, there's not a legal definition of a mutual fund, but it's most commonly applied to those collective investment vehicles that are regulated and available to the general public, and they're open-ended in nature. One of the biggest disadvantages is that that liquidity risk is their price or net asset value is determined only once a day. So when something's value is only changing once a day versus every millisecond like it does for normal stocks, buyers of those get a little wary whether or not to actually purchase them. And that stock price is called the net asset value. And actually, that's how we evaluate those stocks. The other way we could do it is do a stock valuation of every one of the underlying stocks in that portfolio, that mutual fund portfolio. So, one of the other things with mutual funds is they essentially create as many shares as there's demand for and sell, and the mutual fund itself sells and buys them back from you, the buyer, at the net asset value price. So you typically get the price of the fund at the end of the trading session. So if the general investors of that mutual fund or buyers of that want to put in the bid order or want to make a bid on that, they're not going to do it until trading's closed because they want to figure out what it's worth before putting that in. Now, hopefully, y'all watch the stock valuation video. And normally, when students go through this exercise in class, they say, "Wow, is this sort of how you make money buying and selling stocks?" And the answer is, yeah, theoretically, that's how you make it. Unfortunately, though, things don't always work out in theory. And I'll always get a couple students say, "Wow, pretty much any high school student can figure out how to do this. If everybody has the same information, everybody can run that formula, then doesn't everybody have the same information?" And the answer is, yeah, for the most part, everybody has the same information. So the question is, can you really make money buying and selling undervalued stocks and selling them when they become overvalued? And that gets us into an award-winning hypothesis called the efficient market hypothesis. And that suggests that prices of securities fully reflect all available information about the security. If the markets are efficient, then the prices of the security already reflect all attainable information. So, experiencing abnormal returns would be considered just pure luck. In other words, if everybody's got the same information, then why would anybody buy an overvalued stock? And what we realized later on is that not everybody does do that, but instead they use different forms of analysis. And that's what gets into that technical analysis. And in this theory, we have three forms. We have the weak form efficient market hypothesis, which suggests that prices on stocks or other traded assets already reflect all past publicly available information. Money managers can make money if they buy or sell immediately after this information has been publicized. So when the company has an earnings report, you have a very short amount of time before let's say earnings went up, so too should the price of the stock. Then you have 25 minutes or a half hour to sell those shares once it becomes overvalued, or you could buy them if that's the calculation still hasn't figured that. So Then we have semi-strong form, and this is prices reflect all publicly available information and that an investor or money manager can make more than the average return because stock prices will change instantly. You'd almost have to have insider information to make a higher than average return. And then we have strong form, where prices instantly reflect even hidden or insider information, which, by the way, is illegal, and no money manager can ever make more than the average return over time. We think that the New York Stock Exchange is probably somewhere between a semi-strong form and strong form. Whereas the real estate market in South Dakota or in Brookings would probably be considered a weak form market, where real estate agents and those that work in that market and have worked in it for a long time, they can actually make more money than the average person because of that information they possess. But again, that would be a weak form. And we think for the most part that real estate markets are weak form, where not everybody, that if you move fast, you can make more money than average through doing that. Now, generally, supporters of this hypothesis believe that investing in individual stocks is not worthwhile due to the cost and the belief that you'd make a higher return if you simply invest in an index fund, or in other words, in the market as a whole. And as of today, July 19th, 2016, most financial managers, advisors, professionals would suggest that you invest in an ETF or an index ETF that just follows the market as a whole, because only 20% of mutual fund managers consistently make more money in the investing in their portfolios than average. So that means 80% of them don't even hit par, if you will. So in that case, you might as well use an ETF that's indexed to maybe the S&P 500, something like that, and you'll be better off ahead. And that gets us into exchange-traded funds. Now, exchange-traded funds are an investment fund traded on a stock exchange just like stocks are. Their prices change just like stocks are. And it holds assets such as stocks, commodities, bonds. You can get it for just about anything. And it trades close to its net asset value over the course of the trading day. And think of net asset value as the valuation or intrinsic value. Most ETFs track an index. In other words, they have a few people kind of managing the fund, but those managers, and really it's mathematicians and statisticians, their goal is to invest in the appropriate amount of stocks that are in the S&P 500 and are weighted similarly as the S&P 500 weights those stocks. And they design this mutual fund so it goes up and down almost identical to that index. Now, it might not be totally identical, but it's going to be pretty close. So they are attractive as an investment because of their low cost. Typically, the fees on index exchange-traded funds are much cheaper because you don't have a team of financial analysts sitting there trying to find the best investment out there. All they have to do is pick the number of stocks that trade in that index. So if it was for the Dow Jones, they just need to put in there all the stocks that trade in the Dow Jones and at the appropriate size of those companies. So right now, ETFs are the most popular type of exchange-traded product. And again, why do ETFs? Because 80% of mutual fund managers fail to beat the rates of return of an index. And the management fees of ETFs are far less. So in that regard, they're cheaper, so the management fee is much less. And only 20% of mutual fund managers are able to consistently beat the index. Then you might as well just get exchange-traded funds. So I don't usually advise young people or students to start buying and selling stocks, individual stocks. I do in some occasions, but usually that's a business student or an econ finance student. that is trying to better learn how to invest. I don't recommend doing that if they're just purely trying to make money, because they probably won't. But if they're trying to learn how to use this information and how we do in a corporate environment, then I recommend that they do valuations of all that. Some other benefits to ETFs. Single transactions. There's not multiple transactions that go into purchasing ETFs. They're cost effective. The fees are much cheaper. There often are some tax benefits to them. You can invest in virtually anything with an exchange traded fund, including derivatives. There's a lot of flexibility, and there's accountability, especially on ETFs that are traded on our domestic exchanges, such as the New York Stock Exchange. They still have to follow the same rules as a mutual fund or any other publicly traded fund. Management is passive, which means it's the fund managers aren't going out there and trying to dig into the books of every company that trades on the New York Stock Exchange. They're just trying to match an index. Oftentimes, dividends from those are paid immediately, and they're much more simple than getting into the work of a mutual fund and creating a portfolio of those. Now, again, the way in which we evaluate ETFs or exchange traded funds and mutual funds is through the net asset value per share. And the net asset value of the fund's dividends among all the outstanding shares. So if the market values the ETF at a higher price than the net asset value, it would said to be trading at a premium or overvalued. Okay. If the market price, the price on the that Yahoo Finance screen is under the fund's net asset value, then we would suggest that it's trading at a discount, or you can think of it as being undervalued. So if we go to Yahoo Finance and we were to look this up, I would enter the ticker symbol SPY, which stands for the Spider S&P 500 ETF. And right up here, we see the stock price or the price per share on Yahoo Finance, what it's trading at. And it's $215.93. Now, if we scroll down here, we can find the net asset value. It's shortened to NAV. And the net asset value per share is $209.47. If we think of the net asset value as the intrinsic price, then we think it's worth $209. That's what it's really worth, but you can buy it for $215. So would you buy it? And the answer would be no, because we think it's worth $209, but you can buy it for $215. You wouldn't do that because it's overvalued. The actual price of what you can get it for is more than the intrinsic value. So in a nutshell, that's how you evaluate ETFs. You also can do a dividend valuation if the ETF does do pays out a dividend. And really, the way you compare that is you look at the two, three, however many ETFs, and the one that pays the higher dividend would be the one you want to choose, or higher dividend yield would be the one you'd want to choose. And now we start kind of getting into hedge funds. I'm sure all of you have heard of hedge funds. And these are funds that invest in a diverse range of assets, but they most commonly trade in liquid securities that trade on the stock exchanges. They also employ a wide array of investment strategies that will make use of different strategies such as short selling or leveraging. And a little later on, we will get into how to do a short sale, or how short sales work, and how leverage works. Now, hedge funds are usually, can do more things than regular mutual funds. And the reason that is because you have to be what's called a qualified investor to invest in these. You have to have a net income of more than $250,000 a year, or a net worth of something like $1 million a year, and then it depends if you're married. So the average person can't invest in hedge funds. Again, you have to have a high net worth, or you have to make X amount of dollars, $250,000 a year, in order to use hedge funds. Sometimes they're called private equity firms, and there's other things that they're called. We typically, the common word is just hedge fund, even though back in the day when hedging first started, hedge funds actually did hedging. And really what that meant is when the stock market would go up, so too would this hedge funds value. But if the stock market went down, this hedge fund might still make money. And they would employ some strategies to make money when the market was going up or going down. Didn't matter. They would make money. So in a nutshell, that's kind of what a hedge fund is. They can also invest in private enterprise. And again, these are things that a mutual fund can't do. Mutual funds have to buy assets for the most part, or they want to buy assets. I shouldn't say they have to, that are invested in publicly traded securities, because there's a lot of regulation that goes on in that world. But hedge funds, again, can buy and sell any sort of business for the most part. Now, typically, the folks that are able to invest in hedge funds are financial institutions, or what's called institutional investors, banks, other financial firms, and things like that. Then we have pension funds. The South Dakota retirement system, for example, can invest in hedge funds. That, again, is called an institutional investor. University endowments and foundations can often invest as institutional investors. And high net worth individuals called accredited investors. I believe earlier I called them qualified, but they are called accredited investors. They, again, have to have a net worth of more than $1 million. Or make $250,000 a year. And I have a bit of a hard time with that, because those laws came after the Great Depression, when many people lost a significant amount of money in very risky investments. And I don't think in this day and age, and this is just my opinion, that we have the same type of person in our economy that is naive to sort of things being risky, or understanding risk for that matter. So I struggle with that a little bit. And there's an interesting story a number of years ago where I believe it was a marketing executive jokingly put in the Wall Street Journal an advertisement trying to collect money to buy Pabst Blue Ribbon beer, because that was his favorite beer. And the company was selling for $100 million or thereabouts. And he put this advertisement in the Wall Street Journal, just trying to solicit money so he could buy that. And he was doing it kiddingly. He had no intention of actually going through with it. He just really loved Pabst Blue Ribbon beer and didn't want to see it go out of business. Well, a day later, the Securities and Exchange Commission came knocking on his door and pretty much told him he couldn't do that. It was illegal to market to the general population, because they aren't accredited investors or institutional investors, that you can't just put out a general advertisement for those types of funds. And this marketing executive thought, oh my gosh, that's insane. Why would you ever, no wonder our economy is crashing, and why it is the rich keep getting richer and the poor keep getting poorer. And he went and lobbied Congress. Congress subsequently agreed with him that you should be able to solicit money out there for investment. And one of the problems I have, if you've ever heard, the first million is the toughest to earn. That kind of follows this, because once you have $1 million, then you can invest in hedge funds. And it's much easier. Often hedge funds have higher rates of return than other types of investments. So anyway, Congress agreed to go ahead and change the law so we can now use the internet to solicit funds. And that gets us into what's called crowdfunding. And crowdfunding is somebody that's trying to solicit money can get small amounts of capital from a large number of individuals to finance a new business or venture. Now, crowdfunding makes use of the easy accessibility of the vast networks of friends, family, colleagues, so on and so forth, such as Facebook, Twitter, and some of that. The other thing crowdfunding does is it increases the potential for entrepreneurship by expanding the pool of investors from whom the funds can be raised beyond the traditional circles of owners, relatives, and venture capitalists. So if I want to go start a business, I can't, and I'm wanting to solicit quite a bit of money, I can't go out and just ask anybody. The way the laws are written is I can only ask money from owners of similar types of business or owners of businesses, usually accredited investors, relatives, and other angel investors and venture capitalists, again, that usually have high net worth. They have to have a business knowledge to invest in that. Anybody beyond that, I can't solicit money to start my business. Well, with crowdfunding, we get rid of that, and now you can. I think one of the problems, though, they've had with crowdfunding is because very often there's no way to evaluate the price per share or something like that. Instead, what happens is you would get paid in the form of maybe a piece of product that company finally makes. You're not getting the money directly. And I think that defeats the purpose of crowdfunding or its intent in the first place. So there's a number of different websites out there that get into crowdfunding. I'm sure anymore you've all heard of that. But again, not quite the same purpose as what it was intended for. Now we get into bonds. Hey, Barry. And we'll talk about that for a little bit. Now, bonds. Why do bonds exist? And one of the main reasons is a bank can only loan out so much money to any one entity, and that's very much dependent on the number of deposits and how much per deposit, some of those things. In other words, banks have what's called legal lending limits. Let me give you an example. Here in Brookings, we have Dakota Bank. And Dakota Bank's legal lending limit is, to any one entity, is probably like $5 million. Now, I'm not speaking for Dakota Bank. I have no idea what their legal lending limit is, but I'm just trying to use it as a hypothetical, even though I'm using a specific bank. As a hypothetical, they have only X amount they can loan out to any one individual or any one business. So in order to overcome this, what companies can do is now solicit money directly from investors and issue what's called a bond, or a debt instrument that's called a bond. Governments issue these, corporations do, municipalities, including our government. Now, some of the nomenclature to this. Nomenclature, I think, is always a fun word. Sort of the inner guts of these things and how they work. Bonds are usually sold in increments of $1,000 times 5 bonds. So if I wanted to go on TD Ameritrade and I wanted to buy a block of bonds, I would probably have to have somewhere in the ballpark of $5,000 just to buy one of those blocks, even though it comes in a block of 5 bonds and their face value is about $1,000, or it's $1,000 for the most part. Now, I know it's a little goofy. It gets worse, though. Bonds are actually quoted in increments of $100. Okay, so for a face value of $1,000, it's quoted. You just have to move the decimal place 1 over and then multiply it by 5 to figure out what its actual value or what you can buy it for. Which I know is sort of frustrating and confusing. But that's the way it is. So typically, again, they're sold in increments of 5,000 bonds times $1,000 and quoted in the hundreds. The face value would be the initial sale and redemption value of that bond. Now, here's where we kind of have to get into the understanding of how markets work in secondary markets versus primary markets. So in other words, when the company first goes out to do a bond offering, and let's say they need $1 million, they will sell however many bonds at a face value. Now, give me a second here, I'll do some math. So that company that has needs $1 million would go out and sell 1,000 bonds in 5 blocks of 5. So I believe off the top of my head is about 250 blocks of bonds. So when they do that, they're selling it right away or giving out these bonds, and they're getting $1,000 or $5,000. That's the face value. Now, what happens is, let's say I buy one of the blocks of bonds, and I give $5,000 and I get my 5 bonds. If I want to go and sell that bond then, and I need the cash, I'm not going to sell it back to the company. I'm going to go into the bond market and I'm going to sell it there. And the price, even though I gave the company $1,000, I may not get $1,000 from another bond investor. Okay, the company has its money. Now I'm trying to sell it to another investor. Okay, and when that happens, the price fluctuates. I may only get, instead of I paid $5,000, I might only get $4,900 from another bond investor. Now, throughout this time, about twice a year, the company will pay a kind of like a dividend. They'll make an interest payment to all the bond investors, or coupon payment, and that's the amount. Now, once the maturity hits for the bond and the company is ready to pay back all the bondholders, at that point in time, they will buy back those shares $1,000 per or $5,000. Okay, now what happens throughout all this thing is nothing really changes except the price per and the coupon payment, or that twice-a-year dividend that's paid, kind of like a dividend, in interest payments. That stays exactly the same, but the price fluctuates. But at the end of it, the company will pay the $5,000. So all those things, depending, makes the bond price fluctuate, and we determine the bond price by its length of maturity and how much the coupon payments are, and the fluctuation at the time you're selling it. That's kind of how bonds work. And we have different types of those. We have a regular coupon bond, that's what I was describing before, where it makes a series of periodic interest payments called a coupon, plus the principal payment once the bond matures and the company is ready to pay the bondholders. Now, the interest payments are typically made once a year or twice a year. It depends on how it's set up. We evaluate bonds by just similar to price and earnings. The earnings stay static, okay? The length of maturity, and we get into one other principle, economic principle. I want to say competition, but I might be wrong on that, or opportunity cost, is what a bond investor looks at when purchasing these. So then we also have zero coupon or discount bonds, and a zero coupon bond does not pay that interest payment. A zero coupon bond doesn't pay anything, so they're discounted very heavily. Okay, in other words, you may give $1,000 to the company for the one bond. The company then won't give you any amount of money, and at redemption they will give you the full $1,000. But when you purchase it, it's going to be discounted, because that way it appreciates in value. That's essentially what a zero coupon bond is. Now, we determine the value of a bond based on its yield to maturity. And I used to do this whole entire worksheet with students, and I'd go through how you actually evaluate a bond, and a little similar to the stock price, a little more confusing in some regards, but we'd go through and actually evaluate a bond. The thing is, once you start going through it, you realize, well, all you're looking at is the yield to maturity, and the bond with the larger yield to maturity or higher percentage rate would be the bond you want. And going through this just sort of explains the yield to maturity. and how we analyze it. If the bond price equals $1,000, then the yield to maturity would simply equal what the coupon rate is as a percentage of that $1,000. If the bond price is greater than $1,000, the yield maturity is less than the coupon rate, so we'd know whether or not it's higher or lower based on that. And if the bond price is less than $1,000, the yield to maturity is greater than the coupon rate. And if the price goes up, the yield to maturity goes down. Let me make life a little easier for you as retail investors. Here's what you would look at. If I go to Yahoo Finance and enter in composite bond rates, this gives me all the yields for treasury bonds and bills and notes, municipal bonds, and these are the composites or average of all these different rates. So I'll use a 5-year triple A rated company, and these A ratings, we'll talk about that later, but essentially is the risk associated with the company, very low risk in a triple A rated company, and the yield to maturity would be very low. So the average, for the most part, would be a yield to maturity of 0.87. So if I were to go out and buy or want to get a 5-year AAA rated bond, since the risk rating doesn't change, then only thing that changes is the yield to maturity. I would want to make sure I'm getting a bond yield that is higher than 0.87. For example, if it was 1%, then I would be getting better than average. So in a nutshell, for the most part, it's a pretty simple explanation of how you would go out and buy and sell these bonds. You would look at the yield to maturity, okay? If you look at a bond quote, there might be a ton of other information in there, but the big one to look at is just yield to maturity. And that tells what if you hold it to maturity, it will tell you what your yield or payments will be on that. So now, again, for a retail investor, I would stay away from, if you're investing in bonds directly, I would stay away from trading them or buying them, holding them for a year and selling them and doing all that. Usually when you get a bond, you want to hold it to maturity, and in which case, then the yield to maturity would be accurate. Maturities of bonds can be anywhere from 1 day to 30 years. Have a host of different ones. And we have governmental bonds. Government bonds in general are fixed income securities, are classified according to length of time before maturity. These are the three main categories. Now, sometimes you hear people talking about treasury notes or T-bills and things like that. All of those are classified as bonds, but for whatever reason, we differentiate them based on maturity, and we call them something different. So if one of these bonds or debt securities matures in less than 1 year, that would be called a treasury bill or T-bill. If the debt securities matures in 1 to 10 years, we would call that a T-note or a treasury note. And a bond whose securities mature in more than 10 years, we typically call that a treasury bond. Okay. Then we have municipal bonds. In the world of investing, we call them munis, and they are typically the next progression in terms of risk. Cities typically don't go bankrupt that often. Have we all heard of a city that's filed for bankruptcy? Yes, Detroit, and I'm sure there's others. It's not as frequent as corporations filing for bankruptcy. So their risk, again, is typically lower than corporate bonds, lower risk than them, but more risk than the United States government, federal government's debt. The biggest advantage of municipalities or muni bonds is that the returns are free from federal tax. Depending on the bonds, very often those securities, municipals, and treasury bonds, when you file the opposite of taxes. So if you have a treasury bill, in most states that have an income tax, you can write off any gain on your state income tax for that federal. And the same is very much true when filing for federal taxes. the municipal bond for, let's say, South Dakota or for the city of Brookings, you can write that off in your taxes and not pay anything on those gains. Local governments will sometimes make their debt non-taxable for residents, making some municipal bonds completely tax-free. Because of the tax savings, the yield on a muni is usually lower than that of a taxable bond. Depending on your personal situation, a municipal bond can be a great investment on an after-tax basis. You'd notice if you did that asset allocation on that calculator, there was a spot for municipal bonds. Usually you have to be in a very, very high tax bracket to benefit from municipal bonds. Most of us don't have to worry about that, and that's why in an asset allocation, municipal bonds aren't usually a good alternative. And corporations also issue bonds. It issues them similar to that of issuing stock. They go through an investment bank and go out and sell these bonds. Large corporations have a lot of flexibility as how much debt they can issue. The limit is whatever the market will bear. So generally, a short-term corporate bond is less than 5 years. Intermediate is between 5 and 12 years, and long-term is over 12 years. And this is how bonds are rated. S&P and Fitch, the rating company, risk analysis companies, Moody's, all rate these bonds and their risk. Now, in the event a company files for bankruptcy, really the biggest people that often lose out are the common stockholders. But bondholders will often get paid at least a share of what the investor put in. So you may have heard a company filing for bankruptcy and investors or bondholders got 50 cents on the dollar. Okay, so that means instead of getting paid back $1,000 at the end of maturity, they got paid only $500. And that's because bonds are lower risk, and mostly the reason that is because in bankruptcy, they're going to get paid before common stockholders, so are preferred stockholders. So this, from highest to lowest, is the different types of ratings. And I'll look at S&P and Fitch. A very highly rated, low risk, high quality bond rating would be AAA. Federal government, only for a short time ever here, a number of years ago, got downgraded to AA from, well, I think it was AA plus from AAA, but we've gone back to AAA status. In fact, we have often have the lowest risk of most developed countries. And it goes from anywhere from AAA to B and BBB. And you'll notice these are all called investment grade bonds. The super high risk, highly speculative bonds, you'll get a higher yield to maturity. But the likelihood of that company filing from bankruptcy or coming into default is much higher. Now, like university endowments can only invest in investment grade bonds. They can't invest into these any type of junk or speculative bond. Okay, so they can't invest in any of this. They can only invest in BAA for Moody's and BBB and above, because again, they're much lower risk. And the people, let me use a pension fund. Pension funds can only invest in investment grade bonds. In a pension fund, people are reliant on receiving that money. My dad worked for the state of South Dakota and has a governmental, or he was in the South Dakota retirement plan. He receives a paycheck every month based on his former salary and a bunch of other things in a system, but he's dependent on that money, and that's why the South Dakota pension fund can't invest in junk bonds. Now we look here, this was a rating as of November 2012, and these were the average yields to maturity based on a bunch of different types risk-rated bonds. And you can see not very good. Now the biggest impact to bonds is actually the interest rate risk. And that economic term I couldn't remember earlier is what's called a substitute. From the investor's standpoint, they don't have just bonds that they invest in. They have all sorts of different bonds, and the corporation that gets that money doesn't just have to go to bondholders. They can go to banks to get this. So in that scenario, all these things work in substitute or as substitutes. And in that case, what that means is there's an impact that we know when we borrow money or deposit our money at a bank, and that's the fluctuation of prevailing interest rates. So, because these can be substitutes on both sides, that interest rate has an impact to bond yields to maturity. So, if on a 4% coupon par value bond, okay, at $1,000, just one bond, not five, one, if we look at an increase or a decrease in the percentage rate on this bond, so if the Fed funds rate goes up by 1%, this is going to change the price at that moment that bond can be sold at in the bond market. So if we have a 1% increase in the Fed funds rate, and it goes up by 1%, we can see that forces the bond price to go down. Okay, so again, rates increasing causes bond prices to go down. So if you hold a bond, in a perfect world, you would want that interest rate from the Federal Reserve assigns, you would want that to go down, because a decrease by 1%, so if we went from 3.5% down to 2.5%, look what happens with that bond price. And then you would want to go out and sell that bond. Is it would have a change of, you could sell it for $110 or $1,010, but you only paid $1,000 for it. And if we go down to a 30-year maturity and you had a 1% decrease in that Fed funds rate, you could earn $1,197. Now, a 2% increase in the percentage change in the Fed funds rate, it rose by 2%. So instead of 3.5% there-ish that it is today, it went up to 5.5%. We can see that $1,000 bond that you paid for, the price would only be $981. And if it had a 30-year maturity, you could only get $729. Now, if it on a 30-year maturity bond, if the rates decreased by 2%, so instead of it being 3.5%, it went down to 1.5%, that bond, you could go out and sell it in the bond market right away for $1,450. So bond holders and bond investors usually want to see a decrease in the prime rate. They want rates to decrease, which is kind of hoping for a recession, because that's when the Fed would take action and decrease the rate. But I guess if you're a bondholder, that's what you would like. Other than that, the typical retail investor, when they buy corporate bonds or things like that, they're just trying to get the yield to maturity. They're not getting ready and trying to time the market and go out and sell these. But again, you'll want to know if you are a bondholder. In a perfect world, especially if it didn't hurt you, you would like prime rates to decrease, those Fed fund rate to decrease, because an increase in those rates causes that $1,000 par value bond to go down in price. In a 6% coupon bond, we can see the decrease and increase in those rates. It's the same principle, just with higher rates. And the impact of it. We're not going to do a bond valuation. Again, the way we evaluate bonds is really, if we're holding it to maturity, then yield to maturity is typically how we evaluate those. You'd want to check on that Yahoo composite and make sure you're getting a higher yield than what the average is. Now, the reason we want to get higher than this number is because these companies are all rated the same. So, for example, a 5-year AAA rated bond at General Electric, the price might be more than the same AAA rated 5-year bond that 3M is selling for. So the prices are different, even though the yields to maturity might differ a little, but you want to get more than average, is kind of the goal, and the higher the better typically. So you're getting more for the same risk of a company. So again, you just look at the yield to maturity, plan it out to figure out when you'd need that money, and figure that out. Another option, and this is what I recommend, but there are financial gurus kind of get all over the place when it comes to bond funds or bond mutual funds, and buying bonds directly. When you buy bonds directly, the management fee typically is much smaller, and the company is paying for that. In a bond fund, you're paying a mutual fund manager to oversee that. PIMCO Total Return, at least in 2011, was the largest bond fund in existence. And this was the average, I believe, rates of returns, annualized total returns, expense ratio. So that amount that I told you that the management of PIMCO Total Return Bond Fund is getting about 0.71% is payment. I recommend investing in bond funds and not into bonds directly. Let somebody else manage the headache of trying to make the value of those bonds go up. But I don't recommend just going out and trying to buy your own bonds, other than maybe a U.S. savings bond. But again, on TD Ameritrade or Scottrade or Fidelity, I believe you can buy different types of governmental securities on there. So I recommend bond funds. Now, again, you might have a little bit of your money get eaten away by fees, but as long as it's less than 1%, you're probably okay. So again, I recommend bond funds so you're not sitting there playing games. Unlike ETFs, typically most financial professionals would advise using bond mutual funds, and not a bond ETF, or investing in individual bonds because of the arbitrage, which is the difference in price. We were talking about efficient markets before, and there's often bond dealers and brokers. There will be huge differences when those bonds are sold individually, and the difference between maybe what the going rate is and what they're actually being sold for, that portion or arbitrage is the commission for the bond dealer. So that's why I'd advise using a bond mutual fund and not a bond ETF, or buying an individual bonds. And unlike most stock mutual funds, bond funds have been shown to outperform the bond market. Remember, you don't want to pay more than a 1% management fee on that. And that's all we have for this section. We will see you later. Have a good day.